Okay, why don't we get started? So, thank you and welcome to the first 5 years community of practice. So, tonight's topic is going to be getting started with financial planning. So, I'm Ryan Bannock and I'm going to be moderating this evening. Next slide. So, we wish to acknowledge this land on which the University of Toronto operates. For thousands of years, it has been the traditional land of the Huron-Wendat, the Seneca, and the Mississaugas of the Credit. Today, this meeting place is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work on this land. Next slide. So about the first 5 years community of practice. So it is designed for you. We hope it's definitely free, but we hope it's fun and full of answers. The idea is the sessions are highly practical, and we like to tap into the expertise of both speakers and colleagues. So as we go through, if there's something you want to share in the chat, something about a resource you use, or something that you've encountered in your practice or in your life, please feel free to pop it into the chat. To make things fun, every one of our community practices, we have a snack pairing. So we're suggesting tonight, kick back with some hot chocolate and some cookies, have a little snack while we go through tonight's session. This is fully accredited for one main pro credit per session. So I'm Ryan Bannock. I'm a family physician in Toronto in the Jane and Finch area. I'm the Family Medicine Early Career Supports Lead in the Office of Health Systems Partnership at the University of Toronto. I'm also the lead physician of North Finch Foe. I'm the co-chair of the Northwestern Toronto Primary Care Network. I'm also a tariff committee member of the section of general and family practice of the Ontario Medical Association. I will turn it over to Melinda to introduce herself.
Hi everyone, I'm Melinda Caputo. I am sort of the other moderator with Ryan, kind of alternating sessions. I'll be the co-chair of this group. So I'm the first 5 years member of this community practice scientific planning committee, and I'm also a family doctor, a new family doctor. Graduated from Michael Guerin Family Med residency 2024, and I'm now working at Magenta Health in the Beaches.
Perfect. Thank you, Melinda. Next slide. So in terms of mitigating potential bias, so financial contributions. So we actually need to remove this. We don't need to remove this. Okay. And to disclose our financial support, there have been financial contributions from the Fidani Chair in Improvement and Innovation to help us run this community of practice. But in order to mitigate potential bias, the Scientific Planning Committee does have full control over the choice of topics and speakers. Content has been developed according to the standards and expectations of the Main Pro Plus certification program. And the program content was reviewed by a 3-member National or Scientific Planning Committee. And then a shout out and a thanks for joining to Ali, one of our scientific planning committees, who's also just joined us now. Next slide, please. So I'm going to let Yash, one of our first speakers, introduce himself. So Yash, if you want to introduce yourself.
Good evening, folks. So just to give it a sense, my name is Yash Khubchandani. I'm a certified financial planner, a chartered life underwriter, and a certified health insurance expert. I'm a senior regional advisor with OMA Insurance, and I'll be speaking to you more about today's topic further. I also have my colleague joining me in.
Yes, good evening, everyone. I'm Jason Cohen. I'm also an insurance advisor with OMA Insurance, and I will be happy to discuss things with you today.
Thanks. Next slide. So Yash, your disclosure, please.
Yeah, just to disclose, I'm not paid by anyone else other than the OMA Insurance at this point. We are salaried employees, so please feel free to ask us any questions that you have. We're not here for sales today.
As am I. I have no relationships with anyone outside of OMA and OMA Insurance.
And like I mentioned, so I do get paid from the OMA. I do get paid also, I should mention, I speak for the OMA on billing and practice management. So I do get paid by them. I'm on salary from the DFCM Office of Health Systems Partnership. For the tariff committee, I guess it's more of a stipend. At Northwestern Toronto Primary Care Network, I guess it's a stipend/salary. And Melinda?
So I am getting an honorarium as the first 5 years member of this group. And I also involved in the Foundation for Medical Practice Education.
Perfect. Next slide. Okay, so all questions, you don't have to hold your questions till the end. We will be doing Q&A at the end, but if a question comes up, please feel free to put it in the Q&A box as we go through. If you see a question that's been asked and it's very similar to your question, please upvote it because we'll be starting with the questions that have the most upvotes when it's Q&A time towards the end. Again, the chat is really for networking experiences, sharing your experiences, sharing your thoughts. So please let's keep the chat active as we go through. Next slide, please. Perfect. I'm going to turn it over to our OMA team.
Well, good evening, ladies and gentlemen, and thank you so much for taking the time to join us today. The session today is really intended to be educational and informational. The goal here is not to discuss any specific products, but rather to provide a framework to help you as self-employed physician members to better understand how financial planning decisions can help fit together over the course of your career. We've already gone through an introduction here. Next slide, please. So just to reiterate our names and we can move forward, I'm Yash Khubchandani and I'll be joined by my colleague Jason Cohen today. Today's session is really going to be about going over the basics. What is financial planning and how it can assist you? Reviewing the type of accounts that are available for investing and why they matter. Walking you through investment options and what they're made up of. And lastly, going over an important question of when and if you should be looking at incorporating. As mentioned, there will be some time for questions at the end of the session, so please feel free to keep putting it in the chat and upvoting as mentioned there. Next slide, please. Before we move ahead today, just a disclaimer, please keep in mind that this is being provided for as an educational resource for all of you here. All the common circumstances that we're working with here is based on the Ontario physician community that we work with here at the OMA. This is meant to be generalized advice, and for any individual situations, please work with a professional. And for insurance-related topics, you can always help work with us as well. Next slide, please. Our value proposition here is something that I'd like to talk to everyone about here at the OMA. Here at OMA, our value prop is to listen, educate, action, and advocate. What this really means to you as members is the advisory team here at OMA is here to listen to you and analyze to your needs as members, help educate you on available options that help fit you best, and also learn further from your feedback to enhance and create new product solutions that work for you and other members like you as your needs continue to evolve. Next slide, please. Now, as most of you may already be aware, there are various types of advisors in the financial industries. Some of them have a chartered financial analyst designation or a CFA. Some are chartered investment managers or CIMs. This slide here highlights the professional standards us advisors have in the insurance industry. Every OMAI advisor holds the LLQP, which is the Life License Qualification Program. This is the foundational certification required for us to advise members on life and health insurance. Apart from this, we're also licensed through the FSRA, or the Financial Services Regulatory Authority of Ontario. FSRA oversees insurance advisors to make sure that we're compliant, ethical, and following industry regulations. We also align with the CLHIA, which is the Canadian Life and Health Insurance Association, which means our advisors follow the standards set out in the Insurance Act, including fiduciary responsibility when providing insurance and estate planning guidance. Beyond these initial licensings, our advisors complete annual continuing education requirements, which helps ensure that we stay up to date on legislation, product changes, and planning strategies that can impact you as physicians. In addition to these core licensing requirements, myself and many members of our team pursue advanced designations. These include designations like the CFP, which is for holistic financial planning, the CLU, which is the highest designation for insurance and estate planning, and the CHS, which is specific to advanced health insurance expertise. Overall, this combination of licensing and ongoing education ensures that our physician members are getting compliant, accurate, and high-quality advice that's tailored to their needs. Next slide, please. So without any further ado, let's run into our first topic for today, financial planning. Financial planning is often misunderstood as an investment selection. However, in reality, it's a comprehensive ongoing process of defining financial goals. It's a framework that connects cash flow, taxes, investments, insurance, retirement, and estate considerations. Every aspect of a financial plan is interlinked, and investments only form one component. Planning actually ensures that decisions in one area don't unintentionally create problems for you in another area. Next slide, please. Financial planning works best when it follows a clear process rather than isolated decisions. So the first and most important step is clarifying your goals. Now, these could range from personal goals to family goals to retirement goals. Without any defined goals in place, it is extremely difficult to measure progress or have direction. Second is understanding cash flow and tax exposure. As a self-employed physician in Ontario, you are paid a gross income and not a net income, which means you are responsible for tax and other obligations. Without clarity on after-tax cash flow, it is difficult to make informed decisions regarding long-term savings and investments. Third, determining your income structure. Now, this is where it does come into question on whether you would need to incorporate or not, whether you will be retaining any additional earnings or not, and whether that makes sense for your situation. These decisions directly impact your tax deferral opportunities and long-term flexibility. And fourth, selecting the appropriate accounts, such as making use of a TFSA, RRSP, should you be investing within your corporation, because tax treatment significantly can affect your long-term outcome. Account selection is as important as the investment itself for your long-term financial growth. And finally, investing in alignment with your time horizon, risk tolerance, and income needs, and making sure that you review your plans regularly. When coordinated properly, each step builds on the next. Next slide. Now, why does this all matter to you as physician members? Physicians are amongst the highest earners in Canada, but high income does not automatically translate into optimized long-term wealth. Busy schedules, variable income, and high tax exposure can mean that most physicians make financial decisions reactively rather than strategically. Because these decisions compound over decades, even small inefficiencies can have a meaningful long-term impact. In the wise words of Robert Kiyosaki, the author of Rich Dad, Poor Dad, it's not about how much money you make, but it's about how much money you can keep, how hard it works for you, and how many generations you can actually keep it for. Next slide, please. Unlike salaried employees, as mentioned, self-employed physicians wear multiple hats. Firstly, you're paid a gross income, not next, which means you are personally responsible for tax remittances. In addition to this, you do not have employer-provided pensions, neither do you have access to employer-provided benefits, which means you are responsible for planning your own retirement as well as protecting yourself against the unexpected. There's no mandatory deductions such as CPP or EI, which means there's no government support unless you decide to contribute towards these. Now, this does create additional responsibility for yourself, and as you all are aware, there's no paid time off either. So in addition to being a physician who's constantly busy in Ontario, you also have to take the time out to plan for these aspects here. So it does offer an opportunity for flexibility, however, which is where planning comes in and is important. So to talk more to you about some of the registered financial accounts that are available for you to take advantage of, I'll pass it over to Jason.
Thanks, Yash. One of the most important planning concepts is that the account you use can matter just as much as the investment itself. Different accounts have different tax treatments, and using the wrong account can significantly reduce your after-tax returns. Financial planning helps determine the proper order of investing. So we can see here the 5 main accounts that I'm going to talk about a little further now. Next slide, please. So first is the tax-free savings account. Now, the maximum contribution of $109,000 is based upon being at least age 18 from the inception of the TFSA back in 2009. Unused contribution room is carried forward indefinitely. Current annual contribution amount is $7,000 if you are maxing every year. It's important to understand with TFSAs that withdrawals can only be recontributed in the following year if you are at the maximum contribution level. The TFSA's most important strength is that you can have tax-free growth and tax-free withdrawals at any time. And despite high income levels, TFSAs remain extremely valuable for physicians and are often underutilized. They're especially useful for flexibility and short to medium term goals. Next slide. RRSPs, Registered Retirement Savings Plans, these ones are quite popular and quite often used. Now, they work well for income smoothing, but they need coordination with retirement income plans. They provide a tax deduction today with tax paid later upon withdrawal. And from a planning perspective, the RSP is an income smoothing tool. It works best when your tax rate today is higher than when it will be in retirement. And for incorporated physicians, RSP use should be coordinated with corporate income and future RIF withdrawals to avoid higher taxes later. The contribution limit currently is 18% of your previous year's salary. Next slide, please. Registered Education Savings Plans, the RESP. Now, this can often be overlooked during early career years, and you only need to contribute a little more than $200 per month per child to get the full CESG benefit. RESPs are designed to fund a child's education and benefit from the government grants, the CESG. The investment growth in the plan is tax deferred, and withdrawals are typically taxed in the student's hands at a lower rate. They're an effective planning tool for physicians with planning goals. Next slide, please. the RIF, Registered Retirement Income Fund. They must be converted. So RSPs must be converted to RIFs by the end of the year you turn 71. However, they can be converted at any time should you choose. They have mandatory minimum withdrawals, which can push physicians into higher tax brackets later in life if this is not planned for. This is where early coordination becomes very important. Next slide, please. The First Home Savings Account. This is one of the newest accounts created by the federal government for tax sheltering. It combines the features of both the RSP and the TFSA. Contributions are tax deductible, and qualifying withdrawals for a first home are tax-free. This is particularly valuable for residents and early career physicians. The yearly limit of $8,000 can be carried forward, and the maximum deposit is $40,000. Next slide, please. So in this simple example that we're looking at here, we're looking at an investment surplus of $100,000 over a 20-year time horizon. Now, it's important to note the gross annual return we're calculating here is 6%. The top marginal tax rate is 53%. And the effective drag on this would be 2% based upon an average income, not the top marginal rate. Next slide, please. So this is not advice. It's just an example of how tax-sheltered versus non-tax sheltered investing works. For advice, we always recommend to speak with a tax expert, and we have relationships with MNP, one of the largest accounting firms in Canada, if you need assistance with this beyond what we are talking about tonight. So non-registered investments are taxed every year, and the taxes reduce compounding, even with strong returns. Tax-sheltered strategies allow for growth first and tax later. Tax efficiency increases what you keep, not what the markets earn. Deferring tax during peak earning years can accelerate this compounding. Corporate structures can also amplify tax sheltering for physicians. Integrated planning can add hundreds of thousands of dollars to your lifetime wealth. Now, non-registered wealth is important, but it's often done after tax-sheltered investing. And now with that, I'm going to pass it back to you. Over to you, Yash.
Thanks, Jason. Next slide, please. Now, as physicians, you can generally invest through three main approaches. They go ahead into online or robo platforms, self-directed investing, or working with an advisor. In this case, what's important to know is there is no single correct approach. The best option is the one that aligns with your time, comfort level, and the complexity needs of your particular situation. Next slide, please. A great starting point for simpler needs here is the online or robo-advisors. This is most commonly used by a lot of individuals currently. This approach is usually done online and has very little guidance or advice associated with this. Most providers will build you a portfolio of funds by making use of a simple questionnaire that helps assess your risk tolerance. Most of these portfolios are rebalanced automatically on a yearly basis, and since these require less guidance on their end to you, they have lower costs and lower minimums associated with it. It's more of a hands-off approach. Some of these examples include making use of Wealthsimple Invest, Quest Wealth Portfolios by Questrade, BMO Smartfolio, or RBC Investees. Next slide, please. The second approach that we're looking at goes much further than an online or robo-advisor. This is self-directing investing, which in this case means all the responsibility falls now into your hands directly. Here, you would be picking your individual securities yourself. It requires a lot of knowledge, time, and discipline. There may be a steep learning curve associated with this particular kind of investing, and for most physicians, they often underestimate the time commitment and also may not understand or be aware of their own behavioral or cognitive biases in this particular case. There's the cost associated with self-directed investing, once again, is extremely low because all the responsibility is in your hands. But at the same time, that adds additional risks to yourself as well, such as market risk, behavioral risk, or diversification risk, depending on how you're managing your portfolios. Some examples of these are making use of Questrade, TD Direct Investing, or RBC Direct Investing. Next slide, please. The third is one of the most traditionally used options here, which is essentially advisor-led investing. This is where you work with an expert who has your best interest in mind. A good advisor usually will take the time to get to know you and your goals and help you find a way to get there. It really needs to be much more than just what the investments are. Value often comes from avoiding mistakes, such as panic selling during a market correction or managing your accounts to minimize taxation and create an efficient portfolio. Of course, for all of this, this is the highest paying option out of the three, and you do pay a high fee for it, but for most, it can be considered well worth it and can also serve as being an educational standpoint for them to be able to take over the portfolios in the long run. Some examples of these are CIBC Wood Gundy, RBC Dominion Securities, or TD Wealth Private Investment Advice. Next slide, please. Now, if going the traditional route and needing to choose a financial advisor, there are some tips and tricks that you can make use of. First and foremost, check their credentials and licensing. As we went over it in the start of our presentation, look for recognized designations such as a CFP, CLU, CFA, and confirm if they're properly licensed. Credentials usually signal training, ethics, and responsibility and accountability. Second is understanding how they're paid. You can always ask an advisor whether they're fee-based, fee-only, or commission-based to get a sense of how that can affect their recommendations. In this particular case, all advisors at the OMA are non-commissioned, which means we provide unbiased advice to our members. Transparency here always helps avoid any conflicts in the future. Third is assessing fit and communication style. Since this is your long-term financial plan, you should really feel like you are being heard. A good advisor always asks thoughtful questions, explains clearly, and communicates in a way that matches your preference. You need to be reviewing their experience and track record. Always seek experience that's relevant to your situation, depending on whether you're a business owner or physician, you require having complex tax planning requirements. Always ask the advisor for examples of cases that we've worked in, and don't rely just on the promises that they provide of assisting you with what needs to be done. And lastly, confirm a fiduciary mindset and process. Always favor advisors who put your interest first and who follow a disciplined planning process with regular reviews and clear documentation. Now that we've gone over how to choose a financial advisor, I'm going to pass it back to Jason to walk you through investment options and what they're made up of.
Thank you, Yash. So what are you investing in? Products are tools, but strategies do matter more. There are the products, and then there's what the products have in them. As we can see, there's four main components. So managed products comprise mutual funds, ETFs, and fee-based portfolios. But the investments that go into them could be one of four main things: equities, otherwise known as stock or shares; fixed income, which could be bonds, GICs, T-bills, or even preferred stock; cash, which provides a liquidity component to these managed products; and then there's alternatives, which basically means everything else. These may be things such as futures, forwards, swaps, options. Even real estate can be considered an alternate investment. The mix always matters more than the individual product itself. Next slide, please. So mutual funds, very well known, and were very popular, and probably until ETFs took over about 10, 15 years ago. Now they are actively managed, have higher fees compared to ETFs or individual securities, but because of that, they have diversification, and they also have rebalancing built into the portfolio for the most part. Next slide, please. Exchange traded funds. These are increasingly popular, and the most common will mirror an index. That's what we mean by passive. So they'll mirror an index such as the S&P TSX, the S&P 500 in the United States, or the MSCI EAFE index, which is Europe, Asia, and Far East, as an example. Now, unlike mutual funds, they're traded like a stock, but they're low cost compared to a mutual fund. But because they mostly mirror indexes, you know exactly what you're getting. Next slide, please. So in understanding fees is critical for long-term outcomes. Now, fees matter, but good advice should always be considered. When we hear the term MER, management expense ratio, that's usually associated with a mutual fund. Management fees are part of any portfolio product. Now, the next two are advisor fees. So you have your flat planning fees and your asset-based fees. So you can pay a flat fee to a financial advisor to create a financial plan for you, but it is less common. The more common solution is an asset-based fee, usually on a sliding scale. The fee goes lower the more assets you have invested with that advisor. And this is most common for securities-based financial advisors. Next slide, please. So here's an example of how MERs work. And more management fees mean less overall savings, but again, advice matters more. A good advisor will help guide you and help keep you on track. But in this example here, we could see the 4%, the blue line, the 0.25% annual fee. That would basically be if you were managing it yourself, like Yash talked about earlier, where you're taking on all the responsibility and all the risk. A 1% fee would be much more in line with what a financial advisor could charge you for your portfolio. So with that, I'm going to hand it back to you, Yash. Over to you.
Thanks, Jason. So coming back, now we get to the main question here, which we hear from all our physicians. Should I be incorporating? And the answer really is, it depends. Incorporation is not automatically better. It's meant to be a planning tool. And like any tool, it only works if the circumstances are right. There are a few key considerations, however, that can help you make this decision. So the first is, do you actually need all of your income for lifestyle expenses? If you're spending most of what you earn, incorporation may not provide much of a benefit because the tax deferral only works on money that stays inside the corporation for a long term. Second, would you be benefiting from building a tax deferred investment pool inside the corporation? Once again, if this is a long term approach, that is where you will see the advantage because compounding over lower initial tax rates is what can help you build that wealth over time. Third is looking into liability protection. Professional corporation can actually provide protection from non-professional liabilities, but at the same time, it is important to be aware that it does not protect against professional negligence. So that is an important distinction. And lastly, income flexibility. An incorporation allows for income timing and certain income splitting strategies. Though these are more limited today than they were historically, it is still a possibility. So really, incorporation is all about flexibility and tax deferral, not an automatic tax savings. And in the next few slides, we'll break this down further into what it looks like in practical terms. Next slide, please. So let's start off with a non-incorporated physician structure. It works best if most income is required for your living expenses. It's common to early in career physicians like yourselves or during higher spending years. If you're not incorporated, most of your income flows directly to you. Sorry, all income flows directly to you, actually, personally, and is taxed at your marginal tax rate. As you can see on the slide, we do have a step-based tax rate here in Canada, and the higher income that you earn, you're taxed at a higher amount on those highest dollars there. In terms of this, for most physicians, that tax can exceed more than 50%. In this particular case, as a non-incorporated physician, you still have access to tools like RRSPs and TFSAs, but outside of those, there's a limited tax deferral opportunity. The benefit here, however, is simplicity. There's no corporate filings, there's no legal or accounting fees, or no administrative burdens. But the trade-off here is lack of income smoothing and limited flexibility in how and when you can pay yourself. For physicians earning and spending most of their income, this is a perfect structure. Now, income smoothing here, just to define, is the act of paying yourself a portion of your earnings now as per need and retaining the additional earnings to be paid to you in later years in life when you are in a lower tax bracket. And at the same time, income splitting, on the other hand, is the act of using retained earnings to pay your family members a salary, usually someone in a lower tax bracket than yourself. There are rules by the CRA set up for this, and they are getting stricter by the day. So if this is something of interest to you, please feel free to talk to a tax accountant to discuss further. Next slide, please. Now, on the other hand, when a physician incorporates, the dynamics change significantly. The active business income of up to $500,000 within a corporation is taxed at approximately 12.2% in Ontario. Now, this, as you can see, can create a substantial opportunity compared to personal tax rates of approximately 50% or 40% on average with physicians. In this case, you now have the ability to retain earnings inside the corporation, invest them, and control when this income can be paid out to you personally and how much tax this will go through. There's flexibility in paying yourself either a salary or dividends, depending on your planning goals. As mentioned, incorporation isn't automatically translate to tax savings, but what it does is gives you the opportunity for tax deferral and compounding those investments over time. And lastly, planning flexibility. It's this flexibility over time that actually materializes into wealth accumulation. And apart from all of these, corporations also allow you to make use of corporate life insurance to pass off assets that are unused within the corporation to your beneficiaries tax-free on your passing. And at the same time, these policies come with cash values that you as physicians can make use of in your lifetime for purposes such as retirement. One thing to be aware of with regards to incorporation, however, is it is usually a tax deferral strategy and not a tax elimination strategy. So only if the funds remain invested for long term will a corporation be of benefit to you. Next slide, please. As mentioned, incorporations tend to make sense when there's a consistent excess cash flow. If you're earning more than what you need to spend personally, the corporation becomes an additional tax deferral vehicle for you, such as an RRSP. It's also more attractive when you have a longer investment time horizon because it allows for your investments to compound over time. However, keep in mind, when incorporating, there are administrative costs to consider. such as accounting fees, legal filings, annual compliances, and so on. So in this case, incorporation isn't just about the income level alone, it's about the surplus and the long-term planning aspect of it. Next slide, please. This slide here highlights why coordination within a corporation matters. As mentioned, the active business income of $500,000 is taxed favorably at 12.2%. But as you can see on screen, passive income like interest income is taxed much higher inside the corporation at over 50%. Capital gains and dividends also have different tax treatments. So simply investing inside a corporation without understanding the tax mechanics can create unintended outcomes. The key takeaway here is that structure matters. The type of income you generate inside the corporation matters. And that is why planning is not just about investing, it's actually about tax integration. One additional planning tool that's worth briefly mentioning here is the CDA, or the capital dividend account. The CDA is a notional account inside a corporation, and it tracks certain tax-free amounts, including the non-taxable portion of capital gains, and more importantly, life insurance death benefits received by the corporation. When a corporation owns a life insurance policy and receives the death benefit, the proceeds, net of the policy's cost, are credited to the CDA, and the CDA balance can then be paid out to shareholders as a tax-free capital dividend. For incorporated physicians, this becomes a powerful estate planning tool. It allows for corporate dollars, which may have been taxed at lower corporate rates, to ultimately move to beneficiaries in a highly tax-efficient manner. So when we talk about coordination, this seems to be a great example of corporate structure, investment strategy, and how insurance planning all can work together. To discuss how to make use of CDA accounts to provide for a tax-free legacy for your beneficiaries, you can always talk to one of us here at the OMA. Next slide, please. As we wrap up, there are just a few key takeaways from today's session I would like you all to remember. Financial planning is more about coordination than the products itself. The account structure and income structure often have a larger impact on your portfolio than the specific investment chosen. Consistency matters more than perfection. You don't really need a perfect portfolio, but what you do need is discipline and coordinated execution over time. And finally, the goal of today's session here was to build awareness and clarity, not specific recommendations. Having a framework can help you ask better questions and avoid common costly mistakes over the course of your career, especially in a case like yours, which is high income and high tax exposure. Next slide, please. Now, I understand we've covered a lot of ground today, including accounts, investing styles, incorporation, and corporate tax mechanics. So before we wrap up, if there's any questions, please feel free to bring this to us. And lastly, I'd like to take the time to thank Dr. Banak and Dr. Caputo for this opportunity to present. We appreciate it.
Yes, thank you so much.
Thank you. So we're going to start going through the Q&A. If you still have more questions, feel free to add them in. And again, please upvote anything that you feel you want to hear about first. So let's talk a little bit more about incorporation. Actually, before we do that, I actually want to share some personal life experiences. So we heard from two experts. I don't know if I did everything correctly in my financial journey, but I just want to share, I graduated and started practicing in 2010. I actually didn't incorporate myself until 2015, right after I bought my house in 2014. My wife did all the renovations she wanted. I then decided I could save a bit, so I incorporated in 2015. I waited a bit longer and I actually got a whole life policy for income transfer, generational wealth to my children. So if that was 2015, let's say around 2020, 2021. So different things might be right at different points of your journey, and things change. And again, I don't know if I did it right or wrong, but just to share a personal experience of kind of how I did things.
I think the fact that you're here, Dr. Banak, is what matters most. So
yeah, there is no right or wrong, Ryan. It's just how it is.
Okay, so let's talk a little bit on incorporation. So for someone who's incorporated, can you please explain how taxes work on the non-registered account in the corporation? For example, if you made a profit of 100K a year, how much taxes do you pay? The following year, say you made 200K, now do you pay taxes on the amount you paid the previous year as well?
So in this particular case, I'm happy to take the question here,
Dr.
Please. So with regards to these profits, again, non-registered accounts within a corporation aren't taxed on a standard basis. It really comes down to the type of investment that you're holding within that account. If these are capital investments, they're still taxed at the 25% bracket rate, whereas if they're passive investments that are making interest, they're going to be taxed at the 50% rate. It works exactly like a regular non-registered account, where in this case, it is particularly the situation that you will be paying tax on the growth that you have associated with every year. So if let's say you had 100,000 this year and you had a 10% return on it, you're going to be taxed on that 10% for the first year. You've now got an ACB or a taxed portion that's now moving forward to the next year of 100 and let's say 5,000 on that. If there's a 50% tax rate, that 105,000 is tax free. Any additional amounts that are being invested next year onwards will then be taxed moving forward. So this is not going to be taxed on a constant basis. It's going to be taxed on a yearly basis here for the new investments being added. However, because all of these funds are held within a corporation, they will be taxed when all of these funds are eventually withdrawn from the corporation on a second basis.
Perfect. Thank you. So still continuing along the corporation questions. So in a corporation, is the 12.2% tax on the first 500,000 before or after expenses?
This is for usually after expenses. So any expenses that a corporate shareholder would have will help to reduce their income down to that 500,000, and then the 500,000 can be taxed at the 12.2. Anything over the 500,000 after expenses will then be taxed at a general income tax rate of 26.5%.
Great, thank you. So you mentioned, you pay tax on the corporation, and then when you pull it out, you pay additional taxes. So we do have a question around that. So the question is, do you get the corporate tax and income tax when you withdraw the investment from a corporation? They also threw in the question about dividends, how those are taxed. And I guess clarify, am I paid in tax twice, or is there some sort of a complement between what I've already paid?
There is a coordination on the corporate side. So in terms of any taxes that have already been paid, they are accounted for. So a corporation is not always going to be double taxing you. There is tax integration provided by the CRA. So in these cases, for any taxes that have already been paid, there is some tax that is withheld at source, which is what they will be collecting from you at those withdrawals. And when it comes to dividends, there are two types of dividends available within a corporation. One is an eligible dividend, and then there's a non-eligible dividend. So depending on the amount of income that you actually make is how these dividends get taxed. Now, an eligible dividend is one that is usually available to you only if you're earning more than $500,000 in terms of an income. So if you're being taxed at that general income tax rate of 26.5% is when you'll be able to use eligible dividends. Because you've already paid a higher tax on the existing income that you've made, you're going to get a tax break on those dividends. And that's why they're referred to as eligible dividends and have a slightly lower rate of around 39%, or sorry, 37%. I apologize. And in the particular case where you are looking to take dividends for under $500,000 of an income, they are referred to as non-eligible dividends, because in this case, you've already got a tax advantage of having to pay that 12.2% on the income. So a dividend will be taxed at a higher rate if you are earning less than 500 and deciding to take out dividends from the corporation.
Thank you for clarifying that. Lots of corporation questions. So, question about income smoothing. So, you had mentioned, taking up more from or people talk about you can take more of the corporation during a low tax bracket year. And I'm going to add on, how would a parental leave kind of work, or if you have a disability leave, how would that work with kind of smoothing out income in a corporation, or how is it useful for those types of things that come up to have a corporation?
Yeah. In terms of income smoothing, once again, all of the income goes inside a corporation. So at the end of the day, you get to decide how much of an income you need. Now, if you are not disabled or not on parental leave, obviously the best way is to maximize your salary so you can maximize your RSPs and so on and leave back any retained earnings within it. But in the case of a disability or at parental leave, you're not making an income, which means you're already in a much lower tax bracket now. You can always make use of some of this income to take out a salary in addition to what you're making through your government benefits or disability benefits in this particular case. And that's where income smoothing comes into play. Think of it as more like an RSP, where you're now leaving the money in your higher tax years. And then whenever you're making less income in a year or later in your retirement years where you've got lesser income sources, you can take this money out and be taxed at an overall lower tax rate compared to earning them at the earlier years.
So, would it be advisable to incorporate while still having a line of credit debt, or should we wait until we're debt free?
In this particular case, I'd say always debts first is the best response. If Jason would like to add something to this, I'm happy to.
Yeah, paying off debt. I've always, in my experience, I have been an investment advisor in past lives. Paying off debt is a guaranteed return because you know what you're paying the interest on that particular debt, so you know what you're getting back as opposed to an alternative investment or doing anything else outside of that. So paying off debt is always the better solution, and just it gives you that peace of mind once the debt's paid.
Just to add to
Thank
that as
you.
well, Dr. Bannock, sorry. In terms of debt paying off is extremely important, but at the same time, you should also, after debt paying off, focus more on filling in your RSPs and TFSAs before you start retaining earnings in a corporation, because those
Yes.
are important as
Yes.
well.
Absolutely.
Okay, thank you. Um, let's switch gears to different types of products like an ETF. So, are there any rules for an ETF in terms of what type of ETFs can be in an RSP or TFSA?
I'll take that one,
Go
Yash,
ahead.
if you don't mind. Yeah, there's no particular rules per se. ETFs in an RSP or TFSA. The advantage, of course, is those are both tax advantageous accounts. So they can grow tax free. You with the TFSA you can take it out tax free. With an RSP you're going to take it out later when you're in a lower income tax bracket. There's no particular rules. Any ETF that is available to be traded because they are traded like a stock. So if they're available and you can buy them here in Canada, then you can get it. There are ETFs outside of Canada that you can get, but it becomes a little more difficult because they trade on exchanges that aren't here in North America. So it doesn't mean you can't get them. It just means it may be a little more difficult to get them if you were a self-directed investor. This is where having an advisor comes into play and is much more important because they can do this for you.
Great, thank you. Um, okay, so a question about being in your first year of practice. So the question was, if you're making about 140,000 in your first year of practice, what percentage of that should you put in an RSP or a TFSA? If you had to kind of pick one of the two or both of the two, how do you kind of balance that one out if you had 140K to play with?
Okay, I'll take that one. Yeah, sure.
Yeah.
That one really depends. The most important thing for that to determine that answer is what are your goals? What I would hesitate to make a recommendation without understanding what's really important to the individual who's talking to me about that. So do you still have debts you need to pay off? Do you have a family? What's really most important to you right now? Instead of thinking this much should go into that account and that much should go into this account. It really depends on the individual, where they are in their lives, and what's most important to them.
Maybe we should add on about when you're allowed to withdraw from an RSP versus a TFSA. Maybe if you can comment a bit more on that, that may shed some
Yeah,
light for the person who asked the question.
absolutely. So with the TFSA, the flexibility of that account is its biggest strength. So you can withdraw from a TFSA anytime. The only thing, as I mentioned in my slide on the TFSA, is that you have to wait until the following year to recontribute if you are at the investment maximum. It's really important to understand this because if you do recontribute, the CRA hates that and they penalize you heavily for it. But if you're not at the maximum and you've only just started to invest in a TFSA, then you don't really have to worry about that. An RSP is typically more of a long-term investment. You're going to be investing for something you're going to be taking out decades later, preferably. Now, you can actually withdraw from an RSP anytime. You're just going to pay withholding tax by doing that. But there's no real rules in it. But from a planning standpoint, a TFSA and its flexibility makes a lot more sense.
Thank you. I don't remember which of you mentioned assessing the experience and track record of an advisor. How would we do that?
In this
Uh,
particular case, I think you can always ask questions, get to know them. Usually, referral strategies, a lot of ways most physicians work with tax experts or advisors or so on too. So I think that speaks for experience in general too. But always getting a sense of what their responses are with regards to session members they've dealt with, what kind of situations they've dealt with. A lot of times, it's better than just getting someone who's going to tell you that yes, I can help you for it. And once again, its experience is based on those credentials and licensing too. That speaks a lot more for that because that's not someone who's been just working for a single year or so on with members, right? So I think that's an important way to get a sense of their experience in general.
Thank you. I would just add on, sometimes you get a sense, right? Maybe 2 years ago, I moved financial advisors and we considered going with one individual who really couldn't be bothered to give us the time of day. And you just got the sense that like they just didn't care. They weren't going to be so helpful. Would they have done a good job in the investing? Maybe, but it's about the relationship being available to answer questions when you need something money transferred. And then we found someone who kind of out of the blue, like is always on top of things, always available, even on vacation. Not that they have to be. So I think part of it's the relationship. And as you start to work with them, you'll get a sense of is this someone you want to work with or not if both are equal and both have sets of credentials.
100%. 100%.
Absolutely. Absolutely.
So also someone mentioned in terms of incorporating the kind of protecting yourself from liability, but not the non-professional liability. So what is a non-professional liability?
Well, in this particular case, it would be outside of your professional negligence. So, as a physician, obviously, if anything were to happen medically and you are being sued for it or liable for this particularly, that's not something a corporation can protect you for. But any personal obligation where you've had tax disputes, work disputes, or anything outside of professional negligence are essentially what you can protect your assets from within a corporation there, right? So this could be auto disputes, home disputes, tax liability disputes, anything outside of there. Yeah.
Okay. For a student line of credit, do you get a tax deduction on the interest rate that you are paying off?
I believe that
I
might be
think
something
you
I would have to take back to you on
probably
this.
talk to an accountant, but
Yeah.
I know when I had student debt, I could write off the loan interest. But this was decades ago because I'm old. So, but I think at one time you could, and it may depend on the structure of the line of credit, whether it's, but yeah, that's probably something for an accountant.
Yeah.
Okay. The heavy loaded question, you'll probably say, is also for an individual or for an accountant. So if you're incorporated, dividends versus salary. Let's go.
Yeah, that's
As mentioned on the
conceptual. I'll
slide
let
here,
Yash take that. I don't know if there's a right
sure.
answer. Uh,
Again, most of these answers are something that you should be talking to a tax expert about. But based on our knowledge here itself, essentially, as mentioned, dividends versus salary. Salary itself, your corporation is paying the 12.2% on it, and then depending on the salary that you're taking out of the corporation, you're taxed based on that level. As mentioned on my slide, Canada tax on a step basis. So depending on the level of income you're taking out of the corporation, you're going to set up your tax efficiency on that income itself. But if you look at non-eligible dividends, so if let's say we're looking at a physician who's earning less than $500,000 a year, you're now going to be looking at non-eligible dividends because you had the a tax advantage of paying 12.2% on that income first. So in this particular case, you're going to be paying almost 47 to 48% on taxes for taking those dividends out. Whereas on a salary, depending on how much you're trying to take that out, the tax rates would be lesser than that. So it's always best to start off with a salary and then move on to dividends. And secondly, another reason why I would consider taking a salary is because RSP limits are based off of a salary. So if I were to take all my income on a dividend, I'm going to have zero RSP room for the year. So it's always best to take a salary to create some RSP room and then supplement it with dividends over and above that.
Thank you. So can you comment on the general concept of a write-off? In the context of a corporation, can you give some examples that are realistic and commonly done by physicians?
Yeah, some examples of write-offs would be essentially employee payments, loan deductibility. So if you've taken a loan for your practice or for equipment or anything else, and you're paying that loan off, you can always write off the expenses there. You can write off, as mentioned, employee expenses. If you're running a clinic or paying rent for any aspects of the space or so on, you can write off those expenses. In terms of insurances, you are able to write off some of the expenses, such as health insurance. Um, I'd say dental insurance, things like life insurance, critical illness, or disability aren't considered to be a write-off. In those cases, they're just pure expenses. But some of the other things are essentially write-offs in this case.
So let's talk about fees. I'll ask you the first one that may be a bit easier. So to create an incorporation, some accountants say you need to pay a lawyer about 3 to 4 thousand as a one-time fee. Does OMA provide anything?
At the moment, we're actually working towards building a relationship with some people who can help assist incorporating. The OMA does provide incorporation assistance. We do have an email for that. We're happy to share that with you guys here. You can always send in a request to the OMA, and then they can assist with helping you connect with someone there for it.
So off the top of my head, when I looked into this a few years ago, the OMA does have an incorporation service. It is not free. It's one of the few things that the OMA actually can't do for free. Most of the other advice is free.
Yes.
It was roughly $1,000 or so way back when. I did not go through that route. To be fair, I have lawyers in the family; they just all did it for me. But yes, so the OMA is cheaper. It's more of a boilerplate. So if you have some, abnormalities or some different circumstances, maybe it won't be as good of a fit, but for the standard template, it could be good. You can definitely reach out to OMA Legal and ask a question and see what they say before you decide if you want to go ahead with them or not.
Yeah. I think we
Oh,
have a
and Ali
testimonial at the
Damji,
bottom too from a few
yeah,
who've done
let
that.
us know right over here in the chat that he did it via OMA and it was a great process and it was less than 1,000. He thinks it was maybe about $800 when he did it in 2019.
Great.
Again,
So we got an
Ali, I
endorsement
may
there.
one up you. My wife was free, but other than that, $800 does seem like a pretty good deal. Okay. Again, fees, and it may have to be, Ali and I make answer this. I don't know if this is something our speakers can answer. How much should a tax accountant ballpark charge for corporate taxes?
Yeah, I don't think we can answer that.
To be honest, that's a
Yeah,
range. There's no specific
yeah,
set. It is a private service, so at the end of the day, it's really dependent on the accountant on how much they
yeah.
want to charge. There
I,
is no fixed answer for that.
I'd say very much
Um,
like looking for a financial advisor. Sorry, Dr. Bannock, if I may. I'd say very much like looking for a financial advisor. You can shop around and look for accountants and find ones which are a good fit for you. Do they answer your questions? Do they respond to you? You're hiring a professional to help you and you're paying them good money. So you should make sure that they match with what you're looking for.
I will say off the top of my head, 3 to 6,000. You can probably pay less. I don't know if you're getting quality service. I don't know. I'm not an accountant. You could probably pay more. Maybe you're overpaying, or maybe you have a special circumstance that really requires it, and you're paying for that expertise to save you money. But probably 3 to 6 is probably a rough range of what most of my friends are probably paying. Okay, a few more questions. The last few minutes we have. At what age can you withdraw from an RRSP without getting penalized?
I'll take that one. There's no real penalization for taking out of an RSP. You just simply have to pay the taxes on it. And there is no age. Like I said, you can take money from an RSP anytime you want to, but they will have a withholding tax depending on the amount that you take out. I think it starts up to $5,000 at 10%, and then 5 to 10,000, it goes up, etc. And then it caps out at 15% taxes. And then you may pay more than that if because it gets added back to your income. It's simply reversing the tax benefit you got when you invested into it. This is why typically an RSP makes more sense by deferring it as long as possible and not taking it out until you have to, again at that age 71, and that's when you're mandated to start taking it out and using it as income. So taking out from a RSP, it's not really a penalty, it's just simply paying the taxes back. You're really reversing the benefit you got by putting the money in.
Perfect. Thank you. Some questions about the TFSA pulling money out, putting it back in the
Mm-hmm.
same year. The
Yep.
question is, if you transfer from one TFSA account to another TFSA account in the same year, are you still penalized?
I, Again, you wouldn't really be penalized. The only caveat is looking for making sure that if you are at the TFSA maximum and you withdraw, you have to wait till the following year to put back in. If it's a transfer and it's handled properly by your advisor, there shouldn't be a financial transaction by doing that. If it's known as an in-kind transfer, where you're just simply moving it from one to another, which you may be able to do depending on the kind of investments that you're in, the kind of product that you're in. An in-kind transfer won't trigger a transaction. Therefore, you should be able to move it from one to the other. And again, if you're not at that 109,000 maximum contribution amount and you've got plenty of room, you won't really have to worry about it typically. But again, this is something you want to make sure you're talking to your advisor about, or if you're self-directing, you want to make sure you're doing as much research as possible.
So I'll toss this one to you guys and I'll add an after. So how much of your income as a non-incorporated physician, but I guess it's really the same if you're incorporated, should your income go to paying off debt as opposed to percentage of debt versus non-debt payments like lifestyle and things like that, living life? Is there a rule of
Yeah.
thumb how much I should save versus how much I should use to enjoy my life?
Yeah. I don't think we can answer that. It's
Yeah,
really, yeah, that you need to sit down with your advisor, determine your goals. I know I sound like I'm repeating myself, but you want to make sure they understand what's most important to you, your family, what are your priorities, what are your plans for the future. It depends on so many different factors to really say what's best. I don't know, Yash, if you want to add anything to that.
yeah, no, I would really come back to it, right? Like, yes, I understand lifestyle requirements are there too, but debt payment, as you know, is an interest-bearing account. So in this particular case, the quickest we can pay this off, the more we can spend towards our lifestyles in the long term. So I'd probably say managing that best is based on those long-term goals. So it's best to sit down with an advisor to get a direct answer for that. There's no right answer for it
Yeah.
directly.
Some people are fine having debt. It doesn't bother them. Others, they hate it. They just want to pay it off as soon as possible. So it really depends on the individual.
I think it's a bit of a bigger question about kind of delayed gratification with all of our years of training and,
Yeah,
if you'd spend or keep on saving because we don't have a pension. And I think, again, it's your personal experiences, where you are in life, what you're looking for. Like we as physicians, we know, you're not guaranteed to live to 90. Like we see tragic cases all the time. So I do think it's a balance between, planning ahead, planning for the future, assuming you're going to be around, but also capitalizing on the present where you have your health, or maybe if you have kids and they're young and you want to do certain experiences with them. I mean, you got to kind of balance all of those things.
absolutely.
So why don't we take maybe one last question? So some confusion this evening. So why don't we kind of just hammer it out, and this will probably be our last question. So again, about incorporating, this physician doesn't understand. So if they take out 150K, in addition to paying personal tax on it, am I also paying taxes for taking it as a dividend or salary? And they're also confused about the dividend or salary. So maybe if we can just kind of explain what happens, you something's in the corporation, you take some out. So where the tax is paid in the corporation, maybe where the tax is paid personally, and then maybe a bit of a recap about the dividend versus salary overall. I know we covered it, but maybe let's just cover it
Yeah,
one more
well,
time.
definitely. Like mentioned again, so let's say we're assuming for a physician making less than 500,000, they're paying that 12.2% tax on source when the money goes into the corporation. So they've already essentially paid around 12.2% on this money here. And as mentioned, the CRA does provide for tax coordination in this particular case. So when they are taking a salary out, the CRA will take into consideration the fact that they've already paid some taxes on this income within the corporation, and along with that, charge the remaining balance to them when taking it out. The idea of an incorporation is to keep a similar tax rate if you're taking it personally or from a corporate standpoint. So at the end of the day, if they'd received it directly as salary or they took that salary out of the corporation, they would most likely pay a similar tax rate in this case. Now, moving forward from salaries, coming down to the dividend aspect, as mentioned, there's two dividend options, a non-eligible dividend and an eligible dividend. Non-eligible dividends are the ones that are available for someone earning less than 500,000, and that is purely because of the fact that they've got a great tax treatment on the first 500,000 of 12.2%. So because they were paying a lower tax rate on that corporate income, if they're trying to take it out as a dividend, they're going to pay a higher tax rate on it as a non-eligible dividend. Now, again, because of coordination, there will be some money given back to them or a credit provided to them for the dividends itself, or a dividend tax credit in this particular case, as the tax system refers to it as. So it helps balance out for those initial taxes of 12.2% that they already paid on that income. But again, I would say in this particular case, you're going to be wanting to talk to the accountant more to get a better sense of it. But in the general sense of it here, you're essentially going to be looking at averaging out whether you take it as a dividend or a salary under that 500,000. You're just going to upfront pay more for that dividend than you might pay for a salary.
Thank you. If I can just ask Marissa if you can just put up perfect. So I do want to thank, yep, so just going to wait for this to come up. So actually one slide back, if you can actually go one slide back for me, Marissa. No, one slide. No, back, not forward. Sorry, back. Yes. Okay. So I want to thank Yash and Jason for coming today. If you have any questions specific to their area of expertise, this is how you get a hold of them. I'm actually also going to put in the chat any general OMA questions. So although I'm sure Yash and Jason could also kind of forward you on to OMA Legal, info@oma.org. Any question you have for the OMA, they'll actually figure out where it's supposed to go. So if your question is, how do I incorporate or how much does it cost? You can just email that email address and it will somehow make its way to legal, and then you'll get your answer from them. So again, direct insurance questions, you have the email on the screen, but general OMA questions are going to be info@oma.org, and also with that legal incorporation, you can go that route as well. Next slide, please. So upcoming sessions. So our next session is going to be on March the 24th, and it's going to be about patient referrals using e-consult, e-referral, and scope. Registration is open, and you can always contact us at dfcm.quality@utoronto.ca. Last slide, please. And an evaluation. If you can just take a minute to do the evaluation, we're also going to send it to you. In the evaluation, we also ask you about topics for the future, what worked, what didn't work. So please share that information with us so we can plan these sessions on your behalf. So again, if you can just take a moment and fill in the evaluation. And I do really want to thank Jason and Yash, and behind the scenes did a lot of work. I saw they joined here as panelists, Priya and also Lily from the OMA. And I also saw Michael Hartman had joined as well. So also thank you to the entire OMA team who had kind of joined to help us out in the behind the scenes planning. Thank you also to my scientific plan committee. And of course, Marissa behind the scenes. Nothing would happen without her. And thank you to everyone who came tonight. And I hope you guys learned a lot.
Thank you all for joining.
Thank you, everyone.
Have a good evening.
Have a good night.